All right, let's get right to it. Today, we're doing more than just analyzing a stock. We are building a professional, repeatable framework, a playbook really for navigating those incredibly volatile, headline-driven companies. You know the ones. They can either make your year or completely wreck your portfolio.
And it all boils down to this one crucial question, doesn't it? When is the right time to actually buy a stock like that? Answering this correctly is what separates disciplined, systematic investors from speculators just chasing the latest news story. And look, the answer isn't about guesswork or some kind of gut feeling. It's not having a system, a playbook. So today, I'm going to walk you through an expert-level playbook designed to answer that very question. And we're going to use a perfect, real-world example to do it. The electric vehicle maker, NIO.
Okay, let's dive in. Chapter 1. The first part of any solid playbook has to be about understanding the price action itself. We need to learn what the chart is telling us right now, objectively, without any emotion clouding our judgment. To do that, we use a really powerful tool called the momentum cascade. Now, it sounds a little technical, but the idea is actually quite straightforward. It's a method that lets us look at price changes over 3 distinct time frames, short, medium, and long term, all at the same time, giving us a complete picture of a trend's health.
So take a look at this. This is the momentum cascade for NIO. You see those 3 lines interacting? Now, I know it might look a little complex at first glance, but the rules for interpreting it are actually simple. And frankly, they're designed to do one thing above all else: keep you out of trouble.
Here's how you read it. First, we need to be in a healthy, bullish environment. That means the medium and long-term lines, the 12-week and 24-week trends, they absolutely must be rising. If they're not, we're not interested. But if they are rising, that's when we look for our entry trigger, a quick dip in that short-term 4-week line. We wait for it to dip negative and then hook back up. You see, that's the definition of buying a healthy pullback, not trying to catch a falling knife.
So, what does this tell us about NIO right now? Well, we can see these sharp bounces, for sure, things you could maybe trade. But what it doesn't have is that sustained, rising long-term momentum that our playbook demands. This chart is basically screaming choppy and fragile, not new bull market. All right, on to Chapter 2. Because a healthy-looking chart is completely meaningful if the company behind it is fundamentally broken. At the end of the day, price always follows the fundamentals. And this chart right here clearly shows the first major fundamental problem for NIO. The company is consistently losing money. This line is its earnings per share over the trailing 12 months, and you can see it's remained deep in negative territory.
Now that earnings problem immediately creates a valuation problem. The most common metric we all use, the price-to-earnings or PE ratio, is totally useless here. Because the E for earnings is negative, the entire ratio is negative. That means you can't use it as an anchor to figure out what's cheap or expensive. It's like trying to navigate without a compass.
Just to put this into perspective, compare it to profitable automakers which trade at around 7 to 8 times their earnings, or the broader S&P 500, which is up around 25 to 30 times. It becomes very clear that NIO is in a completely different risk category. You are not investing in current profits, you are making a pure bet on a future turnaround.
A smart investor never relies on their own analysis in a vacuum. So for Chapter 3, our playbook includes 2 critical external sanity checks just to confirm our thinking and make sure we aren't missing anything obvious.
And our checklist here is simple, and more importantly, it's non-negotiable. First, we use the Zacks rank. We require a stock to be a number 1 strong buy or a number 2 buy. No exceptions. Second, we look for insider buying. We want to see the top executives, the people who know the company best, putting their own money on the line and buying shares. As you can see from the big red fail marks, NIO currently passes neither of these tests. That's a huge warning sign.
Okay, so let's just quickly recap. We've analyzed the momentum, we've dug into the fundamentals, and we've applied our external filters. Now in Chapter 4, we assemble all of that intelligence into a disciplined, actionable game plan. Now this, right here, is the heart of the entire playbook. Notice the order. You don't even look at the price chart in Step 2 until the fundamental conditions in Step 1 are met. It's always fundamentals first, then technicals to time your entry. This discipline is what protects your capital. Steps 3 and 4 are simply about managing your risk and being aware of the broader market. Okay, with our framework complete, we can now move to our final chapter, the verdict. It's time to make a clear, unemotional, data-driven decision on NIO as of today. So when we run NIO through our rigorous scorecard, the conclusion is pretty much unavoidable. Analyst rank? Fail. Positive earnings? Fail. A solid valuation anchor? Fail. Insider conviction? Fail. And the price momentum is weak and fragile. Based on our rules, this is simply not a high probability investment right now.
Now, it's really important to be clear about this. This isn't a verdict on whether NIO is a good or bad company, or if it will succeed in the long run. It might. But the verdict from our rules-based playbook is that the optimal low-risk time to buy, it just hasn't arrived yet. The disciplined strategy is to wait.
And this case study really leaves us with a final critical thought. In a market that is constantly screaming at you to do something, sometimes the most profitable move you can possibly make is to do nothing at all. In this playbook, patience isn't just a virtue, it's a core strategy.